The risk tolerance of mortgaging your McKinsey salary not once, but multiple times to several different banks just in order to finance his first acquisition is insane. That's not bold, that's scary. But that's exactly how Peter Maria Löw got his start. And in this video, we will explore the investment style, the 4 key lessons that I took away personally from Peter Löw, who is a self-made investor. He created his own investment niche, one that fit his style and where he saw an opportunity because things had never been done this way before. This made him extremely successful, so we've got a lot to learn from him. This video is part of a series where I read books about very successful investors and I study the playbooks of these exceptional investors and I share my key takeaways with you. You can check out the full playlist of these videos up here in the top right corner. But the previous candidates, Calacanis and Peter Thiel, they are in the VC space. They back early stage companies, growth companies, high potential companies basically. Peter Löw was on a different track. He didn't look at startups. He looked at already established businesses that were not running the way they should. They were a little bit in a dire position. Often the management had done a lot of mistakes. Sometimes there was a transition problem with the family not really knowing what to do with the asset. There were a lot of problems usually that came about in these companies where he then came in and turned around these companies completely. The reason why I found it fascinating to learn about Peter Löw's investment style was because his stories reminded me of my time in the family business. I will get into that later on in the video, but I also think that this has a lot of relevance in the VC world. I think he was someone who really shook up the old way of thinking, and with his vision, he brought something fresh and new to every industry that he tackled, and he was quite industry agnostic for that matter. I think especially for Europe this is highly relevant because going against the grain is somewhat frowned upon, but shaking up industries and thinking big is something that Europe could use a lot right now. Peter Löw's framework looks simple, but it's certainly not easy. Here's his modus operandi, his MO. It's first you buy an undervalued company for cheap, then you restructure its operations and improve the profitability, and then you find a buyer and exit that company at a high valuation. That's what he did multiple times. Actually, more than 250 businesses he took over and did his turnaround strategy. That's absolutely legendary. Now let's break down the 4 steps or 4 lessons that we can take away from his career. The first is to start small and bootstrap. Peter Löw learned this lesson early on from his father, who always said, start small and work your way up. And he almost orchestrated his humble beginnings that way because he didn't have much financial capital in the beginning. So he leveraged what he had, his McKinsey salary, and that got him loans from several banks to finance his first acquisition. But this experience turned out to be quite a tough one, and it taught him to never actually rely on banks when it comes to turnaround financing. The great suited men, they're all about just covering themselves and reducing risks to their own careers and protecting themselves. And this leads to very high levels of scrutiny, very high reporting duties that bankers are calling you every day asking how's it going, and in a turnaround you need that breathing room. This just doesn't work in the world of turnarounds. From that moment on, he just avoided bank financing altogether when it came to acquiring a company. Obviously, he used banks in the process. In the day-to-day, you can't completely avoid banks, but in the buying of companies, he did not leverage that. What's interesting about that is that later on in his career, LBOs, leveraged buyouts, became a thing, and he still stayed away from that business model because he just thought that was too risky, and he relied on his self-financing of acquisitions. Although raising equity for a startup is something different, I also tell founders to be very careful and don't give away too much equity, especially not early on. Don't give away control, because you should just start small, you should build, you should come up with something to show before you raise, and you need to demonstrate that you have grit. You need to show that you can make it through adversity. If you raise money just so you can keep tinkering on your idea and you can pay yourself a salary meanwhile, then that's not a mindset that investors like to see. It's all about timing it right. I'm not saying you shouldn't raise money. In fact, it's very important to raise money at the right point, because otherwise you're going to be lapped by competitors from the US who know how to raise money. So it is very important, but the timing is crucial, because you don't want to give away too much of your company too early. You want to raise when it's time to scale and not just to survive. The second lesson from Peter Löw is the operational discipline. Usually when Peter Löw took over a company, he came in and the first thing he did was to fire the management. Now, that is obviously a bold strategy, but he often realized that the incentive structure on the management level, on the C-level, was completely rigged, and people were just keeping busy for being busy. There was no entrepreneurial mindset. With the many companies that he took over, he realized that if you just avoid and then undo the mistakes that the previous management had done, then you're already going a long way. At Adler Modemärkte, for example, which is a retailer that targets older customers, the previous management had tried to completely transform their customer base. They were looking for younger customers, and this strategy completely alienated their existing customers. What did Löw do? He completely reversed that strategy and leaned into his existing customer base. And he grew that instead of trying to find new customers. I found that an interesting anecdote, because at my family's brewery that I was running for a while, there was also a similar situation where there was a new label that was tailored to younger clients, but it had completely different design and did not reflect the company's branding. And the smaller bottles all had this new young branding that had nothing to do with the original brand, which led to like one group being left aside and the other group, they kept drinking the old label things. And the solution was quite simple: to just refresh the label altogether, make it younger, make it new, but keep a lot of the tradition in to not alienate the existing customer base, and then just have all the bottles with the same label so that you know where the branding strategy is going. The next thing that Peter Löw and his team would do is they would plant themselves at the factory. This was obviously necessary because there was a lot to be done, but also it had a signaling effect to the employees, to the factory workers, that these people who came in and just bought this company, they really cared. In a culture, especially in Germany, where every single hour is clocked with your digital card, you are forced to take your holidays, and people almost expect to be compensated for every minute they stay at the company. This thinking is radical. Often founders and startups in these kinds of markets, they suffer because the thinking needs to be different. If you want to create real value, you need to sleep at the factory like Elon Musk did. In a world where you're competing on one side for the best talent, but also against the best talent, it is required to show real commitment to stay ahead. Speaking of talent and team, actually one observation that Peter Löw made was that people who are consultants, funny because he was also a consultant at one point, but consultants come with a mindset that he didn't like. He said that often consultants want to sell you a project that is very long, because a long project means they get higher revenue. But in fact, in a turnaround, speed is of the essence. So you actually want people who get things done very quickly. He says this mindset did not go well with consultants, and that's why he refrained from hiring consultants both onto his team of troubleshooters, but also for his target companies, he rarely engaged consultants. The third lesson we can take away is the exit strategy. He always exited smartly. Once his work was done, Löw didn't hang around and linger. He initiated an exit and moved on to his next adventure. An IPO, or a trade sale to a strategic investor, was his preferred method of selling a business. This made sure that the company had a future and people who really cared about its future, because he says financial investors are more about stripping a company's assets and going after quick financial returns instead of integrating it into a value chain and making sure that it lasts for a long time. For this reason, he says it's better to find a home for the company where you know it will be valued. And the public markets give the right governance structures, at least I guess if you put them in correctly. Peter Löw actually pioneered the SPAC decades before the SPAC actually became a thing. One method that he would take a company public was that he would acquire a public company that was an empty shell, just floating around, listed company, but floating around. And he would then roll up the company that he had already on his other company that he wanted to sell. He would roll it up into that entity, that listed entity. Then he would either do a secondary offering or he would issue new shares from that listed company, and that's how he would then sell his shares on the public market step by step. Building a reputation for finding a good home for his companies really helped him then for his future acquisitions. You got to imagine he did 250 acquisitions. So he really needed to persuade people to sell the companies to him, and that's where his exit strategy also helped him. The fourth lesson is to think for yourself. The title of his business memoirs is Flug, which roughly translates to fluffs. This is because this term became synonymous with industry-specific supposed wisdom that turned out to be complete nonsense. It comes from a story from a weaving factory where Peter Löw was told it was impossible to weave colored yarn, and instead you had to weave white yarn because the fluffs would then interlink. And his solution was a plastic sheet between the weaving machines. So you would have all these weaving machines, all doing white because of the potential cross-contamination. The crazy thing is that they were using white yarn and then having an extra production step where they shipped product away, had it colored, and brought back to then be sold. By doing this operational shift in the company, they were able to use already colored yarn, which improved the quality massively and reduced costs at the same time, which is insane to think about. Just such a simple solution could be such a great shift. This really resonated with me because it's such a simple fix that completely transformed the business, and that's where an outsider's perspective is gold. When this happened to me, obviously on a much smaller scale and with not such a crazy effect, but I was shocked. I was almost in denial because I thought, like, I didn't do anything. I just did what was common sense. Is that all it takes? And this is why this Flug story, the fluffs story, is not just a quirky anecdote, it's a very powerful mental model. It's relevant for founders and VC investors, in my opinion, just as well, because going against the industry norm is extremely tough, and it requires pragmatic thinking and the courage to be contrarian. The next big opportunity often may look silly until it's obvious. If you want to invest like Peter Löw, don't wait for the perfect opportunity. Start with what you have. Focus on substance and bring that together with the vision that you have and the different view that you have as an outsider. Then go in, work hands-on. Don't be afraid to roll up your sleeves. Remember, this is a lawyer turned McKinsey consultant, turned to someone who was climbing over weaving machines and installing a plastic sheet. And lastly, don't follow the herd. Question everything. In a world full of hypes and hot takes, this is the kind of investor that I think we need more of. That's the kind of mindset that I think the world should embrace. The contrarian mindset that led to this fluff story is what makes a great investor. Another contrarian thinker and investor is Peter Thiel, who famously asks in interviews, what important truth do very few people agree with you on? To learn more about Peter Thiel's investment framework and investing playbook, watch this video here.